Gold just hit $5,190 an ounce. Let that number sink in for a second. $5,190. And most people have absolutely no idea why. If you are watching this right now, you are already ahead of 90% of the population. Subscribe to SHF Money right now and hit the like button, because what I am about to tell you changes everything. This is not a story about gold going up. This is a story about power, money, and a wealth transfer that has already started. And the people moving the money do not want you to know about it. Let me set the scene for you. On one side of this story, you have the most powerful financial institutions on the planet. We are talking about central banks, sovereign wealth funds, and government treasuries that collectively hold more gold than any private investor could ever dream of owning. On the other side, you have ordinary people sitting in savings accounts earning almost nothing while the purchasing power of their money quietly disappears. That gap between what institutions know and what you are told is not an accident. It never has been. Now here is what just changed. The United States government, under the pressure of aggressive new trade measures, has triggered something that even seasoned market veterans have not seen in this combination before. Tariffs are back. Not small, symbolic tariffs. We are talking about sweeping, aggressive trade barriers aimed at reshuffling the entire global economic order. And the moment those tariffs landed, something happened in the gold market that the average person watching financial content would have completely missed. Gold did not dip. Gold did not panic. Gold held. At $5,190, gold held its ground like a fortress, while almost everything else started shaking. That is the signal. That is the message hiding in plain sight. When everything else gets uncertain, gold does not run away from the chaos. It becomes the chaos absorber. And right now, that absorption is happening at a scale we have not seen in modern financial history. Here's the part that most people get wrong about gold. They think it goes up because people are scared. That is only half the truth. Gold goes up because institutions are moving money. Big, quiet, deliberate moves by entities that do not appear on your social feed and do not send you alerts. They move slowly, they move strategically. And by the time most people notice, the move is already mostly done. Think about what happened in 2008. When the financial system cracked, gold was sitting around $800 an ounce. 3 years later, it was at $1,900. That was not retail investors panicking. That was institutional money deciding that the system needed a hedge, a real hedge, not a stock, not a bond, not a promise from a government, a physical, tangible, 5,000-year-old store of value that no central bank can print more of. Now we are living through something bigger. We are not just watching one country struggle. We are watching an entire global economic architecture being stress-tested at the same time. You have tariffs reshaping trade flows. You have the Federal Reserve sitting in one of the most uncomfortable positions it has been in for decades, caught between trying to cool down inflation and trying not to break the economy in the process. Every time the Fed speaks right now, markets move violently. Every press conference becomes a guessing game. Every word is parsed. Every pause is analyzed. That level of uncertainty is fuel for gold. The Federal Reserve, uncertainty is not a small factor here. It is the engine driving this entire story. When you cannot trust that interest rates will stay stable, when you cannot trust that the government will have a clear monetary policy next quarter, smart money does not sit in cash. Smart money moves into things that hold value regardless of what the Fed decides. And gold is first on that list. Let me give you a number that will make this real. Central banks around the world bought over 1,000 tons of gold in a single year recently. 1,000 tons. That is not a portfolio adjustment. That is a strategic repositioning. Countries that used to park their reserves in dollars and government bonds started quietly, methodically, building gold reserves at a pace that the world had not seen since the 1970s. The reason they stopped trusting paper assets so completely is a long story, but here is the short version. When you can watch a country's reserves get frozen with the click of a button, when you can watch sanctions eliminate access to the global banking system overnight, holding physical gold starts to look a lot smarter than holding a digital number in someone else's ledger. The world learned that lesson hard, and the response to that lesson is sitting in the gold price right now at $5,190 an ounce. Now let us talk about the tariffs specifically, because this is where the story gets even more important. When the United States puts aggressive tariffs on other countries, those countries do not just accept it quietly. They respond. They diversify. They look for ways to insulate themselves from dollar-dependent trade systems. That means more demand for gold as a neutral reserve asset. Gold does not belong to any country. Gold does not have a foreign policy. Gold does not impose sanctions. Gold just holds value. And in a world where economic relationships are becoming weapons, that neutrality is worth an enormous premium. This is not speculation. This is the playbook that has been used by every major economic power throughout history when the rules of global trade start to shift. In the 1970s, when the United States abandoned the gold standard and trade relationships went through massive disruption, gold went from $35 an ounce to over $800 an ounce in less than a decade. That is a more than 20-fold increase, from 35 to over 800 in less than 10 years. Are we saying gold is going to do that again from where it sits today? We are not making price predictions here. What we are saying is that the conditions that drove that historic move are present right now in a form that is arguably more complex, more global, and more interconnected than anything the 1970s produced. Here's what you need to understand about how these shifts work. They do not announce themselves. There's no press conference where the world's most powerful institutions sit down and say that they are moving out of this asset class and into that one. It happens through accumulation. It happens through small, consistent, quiet purchases over months and years. And by the time the pattern becomes visible in the price, the early positioning is already locked in. The people who were buying gold at $1,000 an ounce were not geniuses. They were just paying attention to the same signals that are visible right now, and they acted. The people who saw gold at $2,000 and thought they had missed it, watched it go to $3,000. The people who saw it at $3,000 watched it go to $5,000. The question is never whether you missed the beginning. The question is always whether you're going to wait for perfect certainty, which never comes, or whether you're going to position yourself based on the information that is available right now. And right now, the information is screaming. Tariffs are live. Fed uncertainty is real. Central banks are buying at historic levels. Institutional money is treating gold as a core holding, not a speculative trade. And the price is reflecting every single one of those forces simultaneously. There is another layer here that most people overlook completely. When tariffs go up, supply chains get disrupted. When supply chains get disrupted, the cost of producing everything, including gold, goes up. Mining becomes more expensive. Equipment costs rise. Energy costs rise. The cost of getting gold out of the ground increases at the same moment that demand for gold as a financial asset is surging. You do not need a finance degree to understand what happens to a price when the cost to produce something goes up and the demand for it goes up at the same time. $5,190 an ounce is not a ceiling. It is a reflection of where we are right now in a much longer story. Let me bring this back to you personally, because that is really what this is about. Every single time in history that a major economic shift has happened, two groups of people emerged on the other side. The first group saw the signals, understood what they meant, and positioned themselves in alignment with where the real money was flowing. They did not need to be the smartest people in the room. They just needed to stop trusting the version of the story that was being told to them and start looking at what was actually happening with the money. The second group waited. They waited for confirmation. They waited for it to be obvious. They waited for someone with a credential and a title to appear on a screen and tell them that now was the time. By the time that confirmation came, the move was largely over. The wealth had already transferred. The positions were already held by someone else. This is not meant to create urgency for its own sake. This is meant to be honest about how these moments actually work. They are quiet at the start. They are obvious only in hindsight. And by the time they are obvious, the opportunity looks very different from what it looked like at the beginning. Gold at $5,190, while tariffs are escalating and the Federal Reserve is paralyzed by uncertainty, is not a headline to scroll past. It is a data point in a very clear pattern. Institutions are repositioning, countries are diversifying. The global financial architecture is shifting beneath our feet in real time. And gold, as it has done for 5,000 years, is absorbing that shift and reflecting it in its price. You now know more than most people watching financial content today. You know why the price held. You know who is buying. You know what the historical parallels look like. You know why tariffs and Fed uncertainty are not just news stories, but structural catalysts. What you do with that knowledge is entirely your decision. But understand this clearly. The window between when information becomes available and when it becomes obvious to everyone is the only window that matters. That window is open right now. Two groups of people will look back at this moment. One group will say they saw it coming and they acted. The other group will say they saw it coming and they waited. Which group you end up in is determined by what you do next, not by what you already know. Stay with SHF Money, because we are going to keep watching every move, every signal, and every shift in this story as it develops. Subscribe if you have not already. The next chapter of this story is already being written.